Let's look here at Chapter 15. It talks about compensation and retirement planning. So we're going to start focusing in a little bit on different aspects related to individual tax. The objectives of the chapter are to differentiate between employee and independent contractors, to summarize the tax consequences of wage and salary payments to employees and employers, to identify the most common non-taxable employee fringe benefits, to describe the tax and financial accounting consequences of equity-based compensation. Also to explain the tax advantage of qualified over non-qualified retirement plans, to contrast defined benefit, defined contribution, and non-qualified deferred compensation plans, and then to describe the tax benefits offered by IRAs and Roth IRAs. So the first thing it mentioned we was going to talk about, and the chapter focuses on, is a question here about who is an employee and why is that important, at least for tax reasons. It says here an employee is an individual, and it mentions an individual whose duties are controlled, meaning as to how, when, and where they do their work by an employer, and is someone who works according to a regular schedule in return for a wage or salary. So who is an independent contractor then? Well, an independent contractor is a self-employed individual who performs services for a fee. However, they control the way the services are performed, and whose work relationship with the client is temporary, and who can have multiple clients at the same time. So why is there importance on knowing if we're an employee versus being an independent contractor? So let's look at what they mentioned here. So employees, if you're an employee, the employer withholds income and payroll taxes from your salary or wage payments, and an employer issues your Form W-2 to an employee. So that's really the key. In my opinion, the Internal Revenue Service would love us all to be employees. If you're considered an employee, based off what was shared on that last screen about, your employer controls where you do your work, they set your schedule, they decide how you're going to do the work. So you follow their policies, their procedures. The more things that you have in common with that, that means you're more likely to be considered an employee. Right? There's no absolute cutoff where you become an employee versus being an independent contractor. It's just the more things that they can show, such as you do not set your own schedule, you use office space at your employer, you follow their schedule, you follow their policies. That means you're an employee. And I mentioned they would love us all to be employees. And why? Because you get a paycheck, you get a salary, and since you're getting salary in those paychecks, on each of those paychecks, you automatically have your payroll taxes calculated. Right? So they're more likely to get payroll taxes from employees and all throughout the year. And on the other side of that, where the independent contractor, where the client doesn't withhold tax from the fee payments. So if, let's say I go cut grass for a bunch of businesses, so I control, it's my equipment, I control my schedule, I'm working for many different clients at the same time, I control when I'm going to be doing it, I work from my home, right? So all those things are outside the employer control. So more than likely I would be considered an independent contractor. Well, why don't they want me to be an independent contractor for tax purposes? It's because, I tell a company I can mow your grass for $500, and they just write me a check for $500. At the end of the year, they do issue a 1099 miscellaneous, assuming that my total for the year is $600 or more, but they don't automatically take out payroll taxes, and they don't pay their share of payroll taxes. Right? So most employers and individuals would probably rather us all be independent contractors because the employer saves some payroll tax, employee saves payroll tax coming out all through the year, and then when you report your income from it, if you have income, you may have some self-employment tax, but that's waited to the end of the year to file and pay. So you're not paying evenly throughout the year your payroll taxes and income taxes related to that. So that's why the IRS would rather us all be employees. We'd rather probably all be independent contractors because that way we keep more money up front and can use it as we need it. Right? There is some responsibility there to make sure we do set aside enough to pay our income and self-employment tax at the end of the year. Right? So that's a little bit on that. The book goes into more into that scenario, but that's to me the basic of what they're trying to get to. And they keep on going here and says the self-employed individuals have a relatively low level of compliance because they fail to file or they understate income. Right? So if you're self-employed, you report your income, but then you can also have, as long as it's considered a justified business expense, you offset your income by your business expense, and then you pay tax on that remaining income, not on your gross income. So there's some chances there for you where maybe you're not reporting all of your income, or maybe some of the expenses that you're using may not be business expenses. So that's why they're saying that there's a lot more chances there. There's a lot more risk. And it mentions here that the Internal Revenue Service takes an aggressive stance regarding worker classification. And in recent years, they have. They've gone in and tried to move as many people to employee as they can. So how is the worker classification decided? And I mentioned there's no one set standard or one set cutoff. It's just a combination of factors. So it's based on facts and circumstances, including things such as does anyone directly supervise the worker, right? Who provides tools and materials used by the worker? And does the worker offer services to the general public? That one about tools, maybe you'll know some individuals who work as mechanics, and to be an individual contractor, that's one of the reasons maybe when they go to work or do work for an organization, that organization makes sure to say, oh no, you need to provide your own tools. And that's because that's one of the things that's looked at as a classification. Let's just look here, let's just assume we've kind of settle that debate or at least understand where we stand. And what are some things, especially with the employee? One of the things you're an employee for, I hope, is so you can get paid. So wage and salary payments. Wage and salary payments are ordinary compensation income to the recipient. So you get tax on it as ordinary income for your wages and salaries. Employees treat wage and salary payments as either, so this is on the business side, the deductible ordinary and necessary business expenses, or in certain cases it can be capitalized, and that we might get to that a little bit, but it's like if you were working on creating a research project, sometimes that's going to be capitalized at least to begin with, right? But that's really what it's getting at there. The employee does have a income treated as ordinary. Employer does have the offsetting expense. It makes a point here to note that publicly held corporations can deduct only $1 million of annual compensation paid to PEO, PFO, and 3 other most highly paid officers. Right, so that might be a statement there. I think you'll see that people or organizations get around that. They mention here a little bit, and I just want to make sure that we at least touch on it for a moment or two, the idea of foreign earned income exclusion. So not everybody's going to qualify. It doesn't mean if anyone that goes outside the United States is going to be able to qualify for this. It's just for if you are doing something, I guess, in their mind that they really think you should be rewarded for, right? To show our appreciation that you're doing something that we think is an important role for a U.S. citizen to undertake, and it requires you to go outside of the U.S. And it mentions here that expatriates. So these are U.S. citizens who reside and work overseas on an extended basis. So it's probably a project base. A lot of times you'll see these being military related or things related to military or providing services to military individuals. Not always. You do see some instances with health care, but it has to be something that is approved. So before you should be notified that you qualify for this exclusion. But if you qualify, you can exclude $108,700 of your foreign salary or raises from gross income for U.S. tax purposes. And then it mentions, since you're excluding all of the income, you're not going to claim the foreign tax credit. So for taxes you paid. But it's still better of the two to exclude all of your income than just to be able to claim the foreign tax credit for the taxes paid. Right, and we'll look at that a little bit more as we go through our chapter related questions. And then they just introduced the idea of another important thing, and organizations and individuals have started getting in trouble more and more with, is kind of, I guess you would say, abusing this employee fringe benefit guideline. So for employee fringe benefit, the general rule is the value of fringe benefits are taxable to the recipient employee. And so in general, everything's going to be taxable unless it qualifies as a non-taxable fringe benefit. And some of the ones you see more often, and it's definitely not limited to this, if you have health and accident insurance, so your employer can provide you with long-term disability insurance, group term life insurance up to $50,000. After that, and I think we'll work through an example, you have this formula to work through about how much is going to be added. So it's an interesting formula. Don't think that if your employer provides you with $100,000 of group term life insurance that you're going to have to add $50,000 of income. No, you would use $50,000 and work through a formula, and it's a lot less. And then another thing that's common is this dependent care assistance, right? So that's things that if they sometimes employers provide on-site dependent care, and that's one of the things there. Then they move and introduce us to employee business expenses. So if employees incur employment-related expenses that are reimbursed by the employer, reimbursement is excluded from the employee's gross income and expenses are not deductible. So in other words, when you're looking at if you have an employee business expense, one, is it something that got reimbursed by my employer, right? So if it did, and again, of the two, this is better because you're getting a full reimbursement for your expenses. However, it's wanting to mention here, in certain cases, and again, it's not everything, you need to make sure that you qualify that your trait or the field of work that you're in qualifies for this. But if you do fall in one of those categories and you have expenses that you're required to pay as far as your W-2 employment and you don't get reimbursed, you can use those as some of your deductions. And then the last thing they mention here is, and this changed, and a lot of people think everything got better with the recent changes, but not. And this is one of them. Employee moving expenses. It mentions here, moving expenses are not deductible. And that used to not be the case. Non-deductible expenses include costs to transport household goods and personal belongings to new locations, travel costs for family members. Those used to be considered the things that were deductible. But now they just want to make sure that we understand that they're not deductible. And it mentions here that any reimbursement for moving expenses paid by an employer is included in the employee's gross income. So again, that's changed a lot. It used to be you would do this little comparison about how far was it from your house to your old employer, and then you did a calculation of how far it is from your new house to your new employer, and then if that was over, I think 50 miles, the difference between those two numbers was 50 miles or more, then you could take some employee moving expenses. This is saying that's gone. You don't get that opportunity anymore. All right, so that's the start of us beginning to work through or at least be introduced to some Chapter 15 information.